Friends, I'm going to discuss with you a very interesting topic connected to the profession of chartered accountancy, of which all of you are aspirant students, on Indian accounting standards, briefly commented as IndAS. Indian accounting standard is a set of standards to bring uniformity in the manner in which accounting books are maintained, financial statements are prepared across business organizations, but more specifically, companies which prepares their financial statements every year, governed by the Companies Act 2013. You must be aware by now that Indian accounting standards follows the international practice of having accounting standards for preparing accounting financial statements. For international accounting standard is known as IFRS, International Financial Reporting Standards. For in a way, financial statements are reporting on financial matters of a company. In India, the parallel to IFRS is IndAS, Indian Accounting Standards, formulated and pronounced by an Accounting Standards Committee or Board under the Institute of Chartered Accountants of India. Now, once they formulate these accounting standards, government notifies to make it mandatory under the Companies Act 2013, which means an accounting standards pronounced by the Institute of Chartered Accountants of India or the Accounting Standards Board of India is notified by the government, Ministry of Corporate Affairs, to make those accounting standards mandatorily applicable on companies which are preparing financial statements. This is similar to international financial reporting standards. I need not explain to you in detail that these accounting standards form the main hub, the point where you can compare the financial statements of different companies. Why? Because all financial statements are prepared according to the Indian accounting standards. If you do not prepare according to the Indian accounting standards, while the accounts are audited, it will be qualified that the accounts are not as per the accounting standards, then the provisions of the Companies Act for punishment and etc. will follow. So therefore, every company prepares its financial statements strictly according to the Indian accounting standards. It has been introduced to standardize the diverse practice of accounting. The main purpose of introduction of the accounting standards is to increase the reliability of financial statements among the stakeholders who read these financial statements for the respective different types of decisions and all those things. Just for information, remember, for you to understand these accounting standards in detail, if you have time, please go through a conceptual framework for financial reporting. Conceptual framework for financial reporting under the Indian accounting standards prepared by the Accounting Standard Boards of India, published by the Institute of Chartered Accountants of India from April 1, 2020, very latest. So if you go through it, you will have a complete idea why accounting standards, what is the purpose behind it, what are the accounting standards, etc. Let me now take you to one very important aspect, that companies shall follow the Indian accounting standards once they have been made mandatory by the Government of India under the Companies Act 2013. Now, before IndAS was introduced, somewhere up to 2002, there were accounting standards. There were few in numbers. Now, after 2002, IndAS have come, almost following the footprint of international financial reporting standards, because a nation's accounting standards cannot differ from the international practices, because many Indian companies would like to go to foreign countries for raising capital, for having interactions, taking loans, etc. So therefore, it is always necessary that the nation's accounting standards is in synchronizing with the international financial reporting standards. But since many companies are not of that size to fully incorporate the accounting standards, the Companies Act has introduced IndAS in phases. Just for information, remember there are 39 Indian accounting standards pronounced by the Institute of Chartered Accountants of India through its board called Accounting Standards Board, 39. Though of course it has pronounced 41 times, Indian accounting standards number 35 and 39 have been removed, have been suspended. So therefore 39 accounting standards. Now, according to the government notification, making it mandatory, all listed companies as on date are subjected to these Indian accounting standards. I shall briefly tell you the number of accounting standards. But you must remember all listed companies. What are listed companies? Indian companies which have been registered with the stock exchanges in India. National Stock Exchange, Bombay Stock Exchange, other stock exchanges to it. So that their securities are traded in the open markets. Such companies are known as listed companies under what is known as SEBI regulations. For all these companies, it is mandatory to prepare accounting financial statements according to the Indian accounting standards, that is 39 of them as on date. This is true from April 1, 2016. For unlisted companies, those companies which are not listed, from April 1, 2017, if an unlisted company has a net worth of capital more than 250 crores, if an unlisted company having a net worth of capital more than 250 crores, then it shall become mandatory to apply these accounting standards when they prepare their financial statements, even though they are unlisted. Now, how do you calculate the net worth? You know the word net worth is. All right. All the assets minus the liabilities. That is all the fixed assets as on date, all the net current assets plus the long-term liabilities. This constitute the net worth. Now, net worth for the previous 3 years will be taken. If the average net worth crosses 250 crores for an unlisted company, it shall become mandatory. But remember, for a listed company, it is mandatory. The moment you become listed, it becomes mandatory to follow these accounting standards. Why this distinction has been made? The distinction has been primarily made to ensure that the companies are able to shift to accounting standards in a phased manner. A small company of having 100 crores capital, 50 crores capital, might find it difficult to maintain accounts, prepare accounts according to these standards, because these standards are quite rigor. They require a lot of information, a lot of disclosures. So therefore, those companies, which are smaller size companies, they can, slowly shift once they touch 250 crores companies. But if you're listed, howsoever small you may be, since you have come to the public domain, public is interacting on your shares, you must follow the accounting standards. The financial statements read by the members of the public, be it a shareholder, debenture holder, or any other investor, should get information according to Indian accounting standards prescribed more. Now, these Indian accounting standards follow two types of things. Following the numbering of every accounting standard has a number. So I will say IndAS 101, IndAS 102, IndAS 103, which means it is an Indian Accounting Standards number 101. Now this numbering follows the number given under International Financial Reporting Standards. So that, whenever there is a comparison between these financial statements and one prepared for that, one can find out the difference and comment on that one to it. First and the foremost accounting standards introduced was IndAS 101, first time adoption of Indian accounting standards. Any company which adopts Indian accounting standards for the first time, by now you know that either it could be a new company or a company becoming listed or a company which unlisted company coming into the threshold of 250 crores and above. Such companies will have to prepare their new financial statements according to the standards prescribed by Accounting Standard 101. So similarly, you have 101, 102, 103, and you have up to 1116, that is on leases. Now, these accounting standards follow a numbering by the International Financial Reporting Standards. In addition to these accounting standards, IndAS has adopted its own accounting standard, Indian accounting standards, which was before introduction of IndAS or IFRS. Let me explain to you this point clearly. As I told you, IFRS came into being roughly about 2000 and IndAS started coming into picture around 2002. So does it mean that there were no accounting standards before that? No. Internationally, there were international accounting standards. In India, there were accounting standards. These accounting standards dealt with very fundamental topic of accounting, inventories, cash flow statements, accounting policies, and events reported after the accounting period, income tax, financial instruments, etc. So these accounting standards were modified to be adopted within the IndAS. What do you mean by modified? Trying to synchronize itself with international accounting standards, trying to synchronize itself with international financial reporting standards, so that any difference is balanced out. So therefore, you have got accounting standard number 2, number 7, number 8, number 10, like that it goes up to accounting standard number 41, which deals with agriculture. So varied topics are being introduced. There are very significant topics, areas where Indian accounting standards sets up the standard. As you might have heard in my lecture on accounting standards prescribe the procedure to record a transaction pertaining to a particular item and keep it in your books, and how do you disclose them in financial statements. For example, let us say earning per share. How is the earning per share is calculated? What are the elements into the earning per share? How do you record them in the books of accounts? And how do you disclose them for either outside authorities or even within the financial statements? These are dealt in accounting standard number 33, Indian accounting standards number 33. Similarly, you have got IndAS 40, investment property. So there are very interestingly two terms are there, investment and property. The accounting standards first explains what is investment, what do you mean by property here, what constitutes an investment in property. Suppose you buy a property to be sold after 3-4 days. Will it be called as an investment in property? Then how do you value those property? How do you record them? Now, how do you record them for the purpose of depreciation? For the purpose of reporting in your balance sheet? These are the issues which are explained in detail and with bold words so that they become mandatory under the Indian accounting standards. This is in brief for you to know that in operation there are 39 accounting standards mandatorily applicable on all listed companies and unlisted companies above 250 crores of net worth. Rest, of course, we shall discuss each of the accounting standards in detail in the videos of Takshila, and I request you to please visit the site and look into those videos explaining to you what are Indian accounting standards item-wise. Thank you very much.